So far, the market is liking what it sees out of Washington, but that's only for today. They did get a deal done, but they really kind of kicked the can down the road for another couple of months. I'm here with Mark Newton. He's the chief technician over at Gray Wolf. So, Mark, you like this move today, but you're concerned about looking ahead, when we get to March.
No, that's true. I mean, short term, you have to respect today's move. Breadth is about 13-1 positive. Advance versus declines. You have over 90% right now of the volume flowing into advancing issues. So it's clearly a good move. The Dow, the S&P, and the NASDAQ are all up right above or at December highs. So it's certainly a positive. And my thinking is we probably can push up to near the level seen last September, which is up near 1465 to 75. But I do think that risk reward increasingly is poor in this move. We started to see signs of waning momentum. If you look at the advanced decline for stocks only, that's really at the same levels we were at back in 2011. And so back at the time when commodities peaked in March, April. So we really haven't made that much progress. And if anything, the last couple of years, each successive rally has gotten weaker and weaker with regards to breadth. And obviously volume, which we've all mentioned here, is a huge concern, which has gotten less and less. So those are big deals technically for a rally that's really lasted over, I think, 45 months from March of '09 up until September of last year. And so it's natural to see, based on reasons like cyclical concerns, the decennial cycle, the presidential cycle suggests that this year has a good likelihood of being far less robust, I think, than what we've seen in the last couple of years. So I actually think that we have a good likelihood of being down for the year, but yet the first quarter, we likely can push up ahead, and it's going to take a number of different retests of these highs before we can actually turn over. We're seeing great strength today in technology again, obviously led by Apple and by a few others, but tech is a big part of the S&P, and that has been under pressure for the last couple months. To see that stabilize and start to turn up is good, and that seems to me to be a better risk reward to take a look at. Tech, energy, and really materials. When you see the move in the emerging markets, with China having broken out, emerging markets versus the S&P has shown very good relative strength. So that's really the area I think that's a better risk reward for investors into the new part of the year versus looking at financials or things that have gotten very, very stretched.
Okay, but then how do you position yourself if you think that you're going to have this fall off in March? Do you get into these things short term but then pull out in March?
Well, a lot of it depends on your perspective. If you're a trader, then you have to simply use moves to the highs of the range to sell into. I think for most investors, you have to use technical analysis and pay attention to the trends, which for now are positive, but yet the momentum's waning a bit. So it pays, I think, to take a little bit off the table into this move, but to still maintain a long bias. We get anywhere up near the highs from last year, I think, is a good area to consider flattening out. But you really need to see signs of deterioration before you can even consider being out of the market or be short, just because there's so many things that continue to work. And the commodities actually are an interesting area to look, which might offer more upside, I think, for 2013 than really equities, with the dollar really starting to accelerate to the downside. And you've seen the move already in energy over the last month, but now you're starting to see precious metals participate. And you'll start to see grains, I think, in the first part of 2013 also move to the upside. So those are areas I would look at that I think are attractive.
All right, so Mark's giving you a little bit of strategy here, what you can do in the near term and what you can look at going out through the rest of the year. That's Mark Newton from Gray Wolf, and I'm Deborah Borchardt reporting for The Street.